Investors and traders, welcome to the channel Market Shock Pattern. Today is 30th of July 2023 and I hope everyone is having a great weekend. In this video, we are going to focus on the US debt market. We will basically be taking a look at the US bond futures, US Treasury note futures, and we will also be taking a look at the 2-year note as well. This video is for educational purposes only and it is not a financial advice. So this past week, it was the week when FOMC meeting took place and the Federal Reserve took a decision about the interest rates, and the interest rates were hiked by about 25 basis points. Now this is quite an interesting one because this interest rate rise has come in after a pause. So the month of June was a pause, and July was a rise of about 25%. And the interesting thing, if you guys were watching the conference or read the summary or the meeting notes which are published, it was a unanimous decision, and also there appears to be a unanimity about the further possibility of interest rate hikes in the future by the board. And also one of the key things to note is there was a mention about the Federal Reserve being data dependent, and also during the commentary and the question and answer, the chairman of Federal Reserve, Mr. Powell, he also mentioned data dependency quite a lot of time. Now we are going into the summer months, the summer holidays. Next month is the month of August, and there will be no meeting by the Federal Reserve for FOMC. The next meeting will be in September, so it will also give Federal Reserve more time in terms of to look at the data and digest that and take that into their consideration for the interest rates going up or down, or for a pause. Now by looking at these markets, the bond market is much bigger than the stock markets, especially the Treasury note market is much bigger, and these markets are also way more sensitive to the interest rate movements than the stocks, for example. So when we are analyzing stocks, by stocks I mean especially the stock index futures, we should also take a look at what is happening in the bond market, the Treasury note markets. So we will start by taking a look at the longer end of the term structure. So this is the Treasury bond futures 30-year duration. It's also known as the long bond futures. So here one of the things at a very high level, macro level, is the concept of bearish asymmetry in place, and this is something, a concept, not necessarily just a bearish symmetry, but it could also be a positive symmetry as well. But the general concept is about symmetry in the marketplace, which we quite like to discuss in our channel. And just to give a short summary of it, what it is basically markets tend to repeat again and again, and we have had a rally in the past. So this is quite a recent past, for about this much, and if we just clone this and we put it here, we have seen basically a great amount of resistance come in at this whenever the market has rallied in terms of magnitude about this much. So this is what the concept of the symmetry is, and what we have also seen is that this market rallied to about this much in terms of magnitude, in terms of symmetry, and also we had some key Fibonacci resistance level coming in, which is the 38.2% Fibonacci retracement and also 50% retracement, and that seemed to have capped the rally. Initially, in our past videos, we were discussing this pattern highlighted in yellow. We were looking for a rally to take place, but this pattern failed, and what the market seems to have done is just gone right here into this this range, and it is really at the 61.8% Fibonacci retracement. But the interesting point is just not the retracement itself, but look, we are potentially at this stage, it is a potential double bottom, and we have here a low formed here. It was not able to take the lows of this one. It tried to rally, the rally was capped, and now it has come back, and it hasn't taken the low out, but it closed as a positive candle last Friday. So this is an interesting development, and it looks like this region where we are, about 124 to about 122, it could be a potentially good support level, and this market perhaps could rally from here. And when the bonds rally, this means the yields fall, because there is an inverse relationship between the price and the yield. So price moving higher means yields coming lower, which is an indication that market participants are expecting for perhaps interest rates to fall or stay put, and might not increase at all or too much. And that is what the reading for the market could be, by looking at if the bonds begin to rally from here. So now one of the things is that if bonds were to rally from here, which is right at the 678.6% Fibonacci retracement, yeah, this is a small retracement, you can see that level has been held. We could initially take to see for the bonds to rally to about 129 to 130 handle, which is about 6 handles higher, roughly speaking, from here, which is quite a bit. And the reason is that there's a possibility that we could have an ABCD pattern setting up here, and also we have this this line I like to call it a ladle line, and we have some potential resistance around here. So there's a possibility the market could in fact rally to about 129, possibly even 130, because that's gonna be if the momentum is really good, it will be taking this swing high out. And also 130 is an even psychological number to take a look at. So this is what we are looking at in terms of the price action, what we can expect in the treasury bond futures. And if these lows are taken out, then that's going to be pretty bearish, which means lower price, interest rates going higher, or yields going higher, in other words. Let's take a look at on this weekly chart basis. So here we go. Here, look, this 122.17 is the line that we have drawn as previous support. It seems to be for the past 3 to 4 weeks, nearly about a month, it seems to be holding. And we have this what I like to call a McDonald's arch pattern, and it looks like it's gonna go on a weekly basis and also touch this 128.24, which is the 20 week moving average. Again, the analysis which we have done on the daily chart. So let's move to the treasury bond treasury notes now. Here we go. So this is the chart, a daily chart of the treasury note futures. This is the 10-year duration. It's the duration is less than the long bond futures with 30 years. The concept of bearish symmetry is still there. Look at this rally, and it's just been capped here. Now, one of the interesting things is just like the bonds itself, look, this level has been respected around 110, and what it has done is actually come down, and here we go, found good support, or at least it was not able to go below the 78.6% Fibonacci retracement, and the 110.26 level provided support, and the candle closed positive. So that's good. And what we can anticipate is pretty much similar to what we were looking at in the bonds. And here we go. So the 1-to-1 projection can actually take us to 113.28, and also that would be a good thing, because it will take this ladle resistance out as well, just coming from the structural part of it. And let's see if there is going to be some retracement level coming around these. Let's draw our retracements, and yep. So the good thing will be that if this ABCD pattern in fact takes place, the 38.2% Fibonacci retracement will be taken out. So anywhere between 113.28 to 114.12 would be the kind of area to look at where this market could go. And yeah, it's possible that we could be in the early stages where this situation with regards to the bond prices, the Treasury note futures turning, and in fact we could have a pretty good rally. So this is what we are watching here. Let's also take a look at the weekly chart as well. So similar to the Treasury bond futures, we have this McDonald's arch pattern here, but again what we see is this level being respected. Here we go, the support level coming in. This has been 1 week, 2 weeks, 3 weeks, 4 weeks, about a month. That's that's pretty good. When last time when it happened, 1 2 3 4 here, going back to 17th of October, we had a pretty good rally. So we had a pretty good rally when this kind of pattern had formed like this. And if we were just to see and repeat that, yeah, it's gonna go and challenge 116 as well as also remain a possibility in the weekly chart. Okay, now something we will try to take a look at, which is gonna be the, if I can find the right symbol, which is 2-year treasury notes. Okay, so guys, I'm not able to find the symbol, but yeah, there we go. Excuse me, I found the symbol. This is the US government bonds 2-year. It's a shorter term duration, 2 years only, and these are pretty sensitive to the interest rate movements. And you can see that on the shorter end of the curve, it's a different kind of a picture. So let's actually move to a weekly chart for now. And what we can see is the chart looks very different to a 30-year and a 10-year. And there's a phenomenon known as the yield inversion. That's kind of what has taken place. And normally you would expect higher yields for a longer duration bonds. Anyway, what I wanted to show was it's at levels where we have possibly some resistance come in, and maybe it's also indicating that there could be some pullback where prices begin to move, or the yields prices begin to move higher and yields begin to come lower. But something I really wanted to show you is this. So this is the monthly chart, right? This is the monthly chart. And we go back really back into the history. So this is 1988. That's the kind of data I'm getting here. But for our purposes, something interesting to take a look at. This is 1989 when it peaked here. And this is a secondary peak coming in the April of 1990. And then the yields began to fall, which means that Federal Reserve either paused or began to reduce the interest rates. And in 1990, 1991, we also had a recession. Now this picture is a little bit different. Here, 1994 December, just the beginning of 95, the interest rates actually move lower. They form a nice one-to-one ABCD pattern here. Then we have another peak coming in May of 2000. And this is a secondary peak in reflection to this one. And after that, we know that in the whole situation with the dot-com bubble, and we had a prolonged recession come in, and here we go. And then that's where it kind of bottomed on the 2nd of June 2003. So this is a monthly chart, so each bar is 1 month. So somewhere in June of 2003, it bottomed and began to rally again. It rallied till June of 2006. So interesting to know that how June, May, these form tops and bottoms. So really interesting level where we are now in terms of being in July to look at this data. And what we have seen is interest rates then just dramatically moving lower. This is the secondary peak coming again in the month of June 2007, and we know that that was the start of the great financial crisis, and the interest rates moved way lower here. We have had a rally, then interest rates bottom around here, and that's when there was talk about negative rates. Thank goodness that never happened in the United States, so that's good. And now where we are, we have had a prolonged rally. This time it has actually broken the symmetry to the upside, but again, it's just really challenging the highs of 2007 and 6 here, and there's a possibility that either the interest rates may not go much higher from here, or they basically kind of consolidate here and then begin to move lower. And that would be like if it forms a secondary high, just the way we have seen here, and that could take a while to happen, and then the rates begin to move lower, or the yields begin to move lower. That would be an indication that perhaps something has started and maybe a recession is coming in. Maybe it could be a serious one or not, or a shallow one. I don't know, it's difficult to say, but what we are looking at in terms of pattern is a secondary high, which normally indicates that okay, now maybe this is a time when the Federal Reserve might start to decrease the interest rates, and rather aggressively at times, and that could be a kind of thing to happen before an official recession maybe perhaps is announced. So somebody asked a question about the interest rates. Very difficult for me to forecast. I can only look at the patterns, and based on the pattern we would look at the 2-year yield. And I think one of the key things to watch in here will be a secondary kind of a peak formation, and if Federal Reserve begins to pause and then reduce rates, then maybe that could be an indication for something starting perhaps. So this is what we are looking at. If you like our video, then please do click on the thumbs up button, and if you find this video of educational value, please do subscribe to the channel, and also hit that bell icon button. That way you will know when the new videos are posted and you will not miss out on anything. Thank you very much for watching the video. Good luck and good trading.